Welcome back to our channel, where we will be diving deep into the terminologies that are essential to help you get ready for your financial certification exams like investment funds and Canadian securities. Whether you're gearing up to tackle your exams head-on or just looking to boost your financial vocabulary, you're in the right place. Don't forget to hit that subscribe button and ring the notification bell, so you never miss an update from us. As always, remember to like, comment, and share your thoughts. Now, let's begin. Arbitration. Arbitration is a method of resolving disputes between parties through a neutral third party, known as an arbitrator or arbitration panel. It is an alternative to litigation in courts. During arbitration, both parties present their arguments, evidence, and positions to the arbitrator, who then makes a binding decision to settle the dispute. The process is often faster and less formal than a courtroom trial, and it allows parties to select their arbitrator and choose a more private setting for the resolution. Arrears. Arrears refer to interest or dividends that were not paid on their scheduled due date but are still owed. For instance, when dividends are not paid to cumulative preferred shareholders as originally scheduled, they accumulate in a distinct account known as arrears. When the payments restart, the dividends in arrears must be settled to the preferred shareholders before common shareholders receive any payments. This ensures that the outstanding obligations are met before any new distribution occurs. Ask price. The ask price is the minimum price at which a seller is willing to sell a financial instrument, such as a stock or a bond. It represents the price at which someone is ready to part with their ownership of the asset. The ask price is a key component in the bid-ask spread, which is the difference between the highest price a buyer is willing to pay, bid price, and the lowest price a seller is willing to accept, ask price. This spread reflects the market supply and demand dynamics and helps determine the potential trading price for the asset. Asset. An asset refers to anything that a company, organization, or individual owns or holds that has potential economic value. Assets can encompass a wide range of items, including cash, investments, property, equipment, inventory, accounts receivable, and intellectual property. These holdings contribute to the value and financial well-being of the entity. In accounting, assets are categorized on a statement of financial position and are typically listed in order of liquidity, with more liquid assets appearing first. Asset allocation. Asset allocation refers to the process of distributing investment funds across various categories of assets, such as cash, fixed income securities, and equities. This strategic allocation is designed to align with an investor's risk tolerance, financial goals, and time horizon. By diversifying investments across different asset classes, investors aim to balance potential risks and returns. Conservative investors might allocate more to lower-risk assets like cash or bonds, while those seeking higher returns might allocate more to stocks. Asset allocation is a fundamental component of portfolio management, helping investors optimize their investment strategies based on their individual preferences and circumstances. Asset allocation fund. An asset allocation fund shares comparable objectives with balanced funds, aiming to diversify investments across various asset classes. However, they differ in that asset allocation funds generally don't have a requirement to maintain a specific minimum percentage of the fund in any particular investment category. This flexibility allows the fund manager to adjust the allocation more freely based on market conditions and the manager's assessment of opportunities and risks. The absence of rigid allocation requirements offers greater discretion to adapt the portfolio's composition to changing economic factors, potentially leading to more dynamic investment strategies. Asset-backed commercial paper. Asset-backed commercial paper is a short-term financial instrument with a maturity period usually lasting less than 1 year, often spanning 90 to 180 days. It possesses a legal and structural framework akin to asset-backed securities. ABCP represents a form of borrowing for companies or financial institutions, where they issue these instruments to raise funds quickly for short-term needs. The name asset-backed signifies that the paper's value is tied to a pool of underlying assets, such as loans, receivables, or other financial assets. The assets provide collateral that enhances the credit quality of the commercial paper, attracting investors seeking relatively secure, short-term investments. Asset-backed securities, ABS. Asset-backed commercial paper is a short-term financial instrument with a maturity period usually lasting less than 1 year, often spanning 90 to 180 days. It possesses a legal and structural framework akin to asset-backed securities. ABCP represents a form of borrowing for companies or financial institutions, where they issue these instruments to raise funds quickly for short-term needs. The name asset-backed signifies that the paper's value is tied to a pool of underlying assets, such as loans, receivables, or other financial assets. The assets provide collateral that enhances the credit quality of the commercial paper, attracting investors seeking relatively secure, short-term investments. Asset coverage ratio. The asset coverage ratio is a financial metric that assesses a company's ability to cover its outstanding debt obligations using its tangible assets. It's particularly relevant for businesses with significant amounts of debt, as it measures the proportion of the company's assets that are available to creditors in the event of default. A higher asset coverage ratio suggests a greater level of security for creditors, as more assets are available to cover the debt. Conversely, a lower ratio might indicate higher risk to creditors, as the company's assets might not be sufficient to cover its obligations in case of financial distress. Asset mix. Asset mix, often referred to as asset allocation, is the distribution of investment funds across different types of assets within a portfolio. It involves dividing investments among various categories, such as stocks, bonds, cash, real estate, and alternative investments. The goal of asset mix is to achieve a balance between potential returns and risk by diversifying across different asset classes that react differently to market conditions. The specific allocation to each asset class is determined by an investor's financial goals, risk tolerance, and investment strategy. A well-structured asset mix can help optimize returns while managing the overall risk of a portfolio. Assigned. Assigned in options trading means that if you're the person who sold someone the option, and they decide to use it, you have to do what you promised. For example, if you sold them a right to buy option and they want to buy, you must sell the stock to them. If you sold them a right to sell option and they want to sell, you must buy the stock from them. Assurus. Assurus is a non-profit organization comprising companies that issue life insurance contracts. Its primary purpose is to safeguard policyholders in the event that a member company becomes insolvent. In such cases, Assurus steps in to provide protection and ensure that policyholders continue to receive their promised benefits and coverage. Assurus serves as a safety net, enhancing confidence in the life insurance industry by offering a measure of financial security and stability to policyholders during uncertain times. At the money. At the money is a term used in options trading to describe a situation where the strike price of an option is exactly the same as the current market price of the underlying asset. In this scenario, the option's intrinsic value is zero, as there is no immediate profit to be gained by exercising the option. Both call and put options can be at the money. This status indicates that the option's potential to generate a profit or loss is balanced, and the decision to exercise the option will likely depend on other factors such as time value and market expectations. Attribution rules. Attribution rules are tax regulations that determine how income, gains, losses, and other tax-related items are attributed or allocated among individuals or entities in specific situations. These rules are designed to prevent tax avoidance by ensuring that income is properly assigned to the appropriate parties, especially in cases involving related parties such as family members or entities under common ownership. Attribution rules vary by jurisdiction and can impact various aspects of taxation, including income splitting, gifts, loans, and investments, to ensure that individuals or entities are taxed fairly and transparently based on their actual economic involvement. Auction market. An auction market is a type of market where securities, such as stocks and bonds, are bought and sold through the interaction of brokers who act as intermediaries for their clients. In an auction market, buyers and sellers submit their orders to brokers, who then execute these orders on behalf of their clients using a centralized trading platform. This contrasts with a dealer market, where trades occur directly between buyers and sellers, often over the counter without a centralized exchange. Auction markets are characterized by transparency and price discovery, as trades are conducted openly and publicly. One well-known example of an auction market is the Toronto Stock Exchange, TSX, where trading occurs through an organized auction process facilitated by brokers on behalf of investors. Audit. An audit is a thorough and professional assessment of a company's financial statements, which is mandated by corporate regulations. The primary objective of an audit is to verify the accuracy, consistency, and adherence to international financial reporting standards in the financial statements. Auditors, who are independent experts, examine the company's financial records, transactions, and internal controls to ensure that the presented information is reliable and provides a fair representation of the company's financial position and performance. Authorized shares. Authorized shares refer to the highest quantity of common or preferred shares that a corporation is permitted to release based on the specifications outlined in its charter or articles of incorporation. This is the upper limit established by the company's governing documents for the number of shares it can offer to potential investors or stakeholders. The authorized shares serve as a constraint, ensuring that the company doesn't exceed the predetermined amount of ownership interests that it can distribute to shareholders. Financial Services Authority. Financial Services Authority is the regulatory body responsible for overseeing and enforcing the regulatory framework governing various sectors within Quebec's financial industry. This includes the securities sector, as well as the distribution of financial products and services, financial institutions, and the compensation sector. The AMF's role is to ensure compliance with relevant laws and regulations, promote transparency, protect investors, and maintain the integrity of Quebec's financial markets and services. Averages. Averages are statistical tools used to assess the overall direction or trend of the market. One of the most widely recognized averages is the Dow Jones Industrial Average. This average provides insight into the performance of a selected group of major companies, often referred to as blue-chip stocks, and serves as an indicator of the general health and movement of the stock market. Averages help investors gauge market trends and make informed decisions based on the collective performance of the included assets. Axe sheet. An axe sheet is a record or list that a trader maintains, indicating the financial products they want to either buy or sell urgently and quickly. It serves as a tool for traders to communicate their immediate trading intentions to colleagues, clients, or other market participants. The axe sheet helps streamline the trading process by providing clear information about the trader's current interests and intentions in the market. Thank you for joining us on this enlightening journey through essential financial terminologies. We hope you've gained invaluable insights that will serve you well on your path to success. If you found this content beneficial, don't forget to give it a thumbs up and share it with your fellow learners. Until next time, keep learning, keep growing, and keep reaching for your goals. Wishing you all the success in your financial endeavors.